Yeah, well, there is a lot of things. I was extremely naive when I started. I mean, I actually just stumbled into the financial sector. My interests were really on like physics and chemistry, and somehow I ended up at business school and then into the finance industry. So that meant that even on the first day when we were starting to plan out how our research department was supposed to work, I was just completely baffled when they said that we will. How are we going to value stocks? How will we set our price targets? And they were started to talk about like we will use price earnings ratios. And coming directly from business school and being very narrow-minded and thinking that I had been taught how it actually is, I thought that what are they stupid? You have to use discounted cash flow analysis, otherwise you haven't calculated an actual value. Was this like PE multiple hocus pocus? So one thing actually the first lesson there, kind of a meta lesson, is that just be open-minded and accept whatever organizational or business area wisdom there is, because there was wisdom in their perspective. And even if PE multiples is perhaps the worst of all valuation metrics, it's at the same time the best of all valuation metrics, because it's so intuitive. Everybody can understand exactly what it is, and if you understand it deeply enough, you can see how the PE metric is actually superior to discounted cash flow analysis, because discounted cash flow analysis can be completely manipulated and not only for tricking others, but mainly for tricking yourself. I did spend a lot of time like perfecting my DCF models and just going through making small decimal changes to more or less just come up with the answer that I wanted. So that was one of the first lessons just from the finance industry in general. But I'm not exactly sure if you want to know my views on coming into the finance industry or the buy side specifically. Or the sell side, the sell side. Sorry, come again.
We can touch a little about because my next question will be, what do you think for people transitioning from sell side to buy side? What kind of advice will you give them?
Okay.
So that's my next question.
Okay, then I'll keep going a little bit on the sell side. So, for example, another thing was that this also has to do with organizational wisdom and to accept whatever kind of structure you enter into. So you both have to accept the structure you come into, but also be open to like discovering new truths for yourself. So, for example, the recommendation structure at a typical sell-side firm, I thought when I got there that I was supposed to do research, objective research on companies, make as good forecasts as possible, calculate the actual value of a company, and issue a buy, sell, or neutral recommendation based on whether there was an upside or a downside. But what I had to relearn, and what was pretty surprising to me, was that to start with, neutral means sell. That's really the most negative you can be, and you're not supposed to ever issue a sell recommendation unless there is some kind of forcing argument behind it, that you have to have a certain number of sell recommendations. Then, well, you'll have to find some company to put sell on, but just you choose some irrelevant small companies. And I also didn't understand that the whole reason behind sell side analysis was to keep good relations with the corporate clients and the portfolio managers on the buy side. So everything you you do, at least the way I perceived it in the end, as a sell-side analyst, is that you are really part of the marketing department of the large corporations. So what you do is you write research where you present companies as from the best side possible, and then you leave it. So that's the part of the marketing department role, and then in terms of communication with your institutional clients, you provide them with as much information as possible, but the recommendations in themselves, they are not that important. So just realizing this, what the structure is all about, that it's about relations, and it's about actually making as much money as possible for mainly your corporate clients, because that comes back to you as a broker firm. And also that you actually don't have the responsibility of making the best forecasts or the best recommendations. You can leave that up to the portfolio managers. They know what to do when they speak to 10 or 20 research analysts on the sell side. So that's not really your responsibility. And I could have cut out I probably the first 6 years of my career as a sell side analyst. I could have made I could, if I had known this from the beginning, I would have made such a much better job, and I also would have gotten better contacts both with the large corporations and with the institutional money managers. And I think this is probably the most important lesson I have regarding surprises when beginning in the industry. I have a list here of a lot of other stuff as well, but I can riff some of them off. For example, that there is it's so much more important in the short term, and the short term is the important term usually if you think of this as a career and in terms of career risk, the narratives and the trends and the perception and the contacts and relations you have, all of that, all this fluffy stuff is much more important than the hard facts, than the historical numbers, than the forecasts, than the precise calculations of value and how that or even assessments of risk. And there was also this kind of hedge fund club kind of structure to the market. But we can maybe talk about that later when talking about the buy side. So let's see what's more here. That's probably well enough for now.
Yeah. So maybe we can move to my second part of what advice you give from sell side or who are planning to buy side.
All right. So just building on what I just said, you have to cultivate your contacts at both the corporations and the institutional buy side, so that they see what kind of value you can provide to them above your data, your models and recommendations. They have to realize, because you will probably move over to one of your clients. The other alternative is, of course, starting your own business, and that's probably a little bit harder and not exactly what you're asking. So you are looking to transition to one of your clients, and the only way I see that they would really go there, because it kind of messes with their own relationship with that particular firm. But imagine that we're talking about Goldman Sachs and some large hedge fund. Then neither side wants to anger the other one, so you have to find like an amicable way of transitioning. But in any way, you show your superior value by being responsive to any type of question, whether it be travel services or representation on nightclubs or whatever. I mean, there's a lot of literature on this. For example, this Beer and Loathing in the Square Mile, City Boy, which is a pretty entertaining book about how to become the number one sell-side analyst, and that was all about wining and dining, which holds actually a lot of truth. But to give some concrete advice, you should really ask your fund manager clients what they expect and what they need. So you ask this in your role as a sell-side analyst, but by doing so, they understand that you will not just be another cog in the wheel. You will not just provide like written research and do everything that's expected of you. By asking them like exactly what is it that you lack. You have chosen us as your service provider. Sure, you do that because of the company name, but I specifically, as for example the banking analyst, I'm asking you, how can I actually help you make a better job in your fund management? And that, I mean, this is pretty easy. You ask what do you want, and then you actually give it to them as well. And of course, tell them that what you really want to do is manage money and demonstrate why you think that would be good. All right. And now I'm assuming that when you say how can I transition to the buy side, the question is, well, there's several questions here. Why do you want to go to the buy side? Why do you think it's better there? The pay is probably worse. You'll get paid less when going there. Are you going there to become an in-house analyst? Then you definitely get worse pay, and you'll in some ways get less freedom. Or is it that you want to become a fund manager? Is that why you're going to the buy side? So I mean, you can be an analyst at the sell side or at the buy side. Going to the buy side, I would assume it's because you want to be a fund manager and possibly also a partner, a shareholder, so that you can make more money. I guess that's why you want to go there. But there is no easy path from being a highly paid and top-ranked sell-side analyst to actually becoming a partner and fund manager at a hedge fund. To transition that way, the only way you can do that is like just really provide a lot of value, and the value you provide as a sell-side analyst, even if your the hedge fund employer thinks that he would make a great addition to my in-house analyst team, there is nothing in that transition that really moves you any closer to becoming a hedge fund manager or a partner. But in anyway, so I'm just want to emphasize that you have to know why you want to move there, because just moving to the other side, to the buy side, it will probably give you less pay, and possibly on the upside, what I actually think is the upside is that you will get access to a lot of other sell-side research. So you would finally get this like Argus eye overview, the helicopter bird's eye perspective of the entire sell-side market. So you would finally get to read all your competitors' research on a timely basis. So what you actually gain from going, so now I'm actually answering the question for why you would want to go there. So you will get less pay, but you will get to know so much more. So what you really would aim to do here is to maybe make one or two round trips from the sell side to the buy side back again to become an even better sell side analyst, and then you will make much more money, because the transition from the buy side back to the sell side side. That's where you can really get paid.
That's an interesting advice, to be honest. I've heard about from sell side advice. It didn't really come in the industry.
I don't think it's common, but that was actually my own plan from right from the get-go in 1994, just when I had started at this small broker firm, and at the absolute first time, I had no idea that you maybe should be a fund manager or maybe an analyst. I had only heard about like being a stockbroker. So I thought that, well, I'm going into the industry and I'm becoming a stockbroker. I have no idea. And then after like a month or so, they said like, you are much more analyst material than stockbroker material. And that got me thinking. So within a few months, I accelerated from knowing really nothing about the industry to starting to plan that, maybe I should like start as a stockbroker, then move over to become an analyst. And then I would realize this and I would learn this and I get these contacts and get a completely different perspective. And then I would move back to becoming a stockbroker again, because then I would be able to speak to my clients in a much more informed and valuable way. And then much later than that, somebody told me about like, what you really want to do is become a fund manager, because that's where the power is, and then you are the client. You don't have to be the service provider anymore, which actually is a pretty nice perspective, and something that I definitely reveled in once I became a fund manager. Like the freedom of never having to service anybody else, but to actually just get serviced. But no, I haven't heard many people do it, but I still think it should be a really good way of moving upward in the industry.
Right. So since you are talking about 1 minute, can you discuss more about your best industry? Like how has evolved time?
All right. So. In the first few years at Futuris, let's hold off on the evolution for a while. Where I'm at now, and where I was most of the time during my time at Futuris, I like to put it really, really simply. So I buy low multiple companies. Like I want the PE ratio to be below 10. That's more or less it. If I can buy a good company where at less than 10 times earnings, then that is cheap, and it will provide me with superior returns. So that is really the big part of the investment philosophy. The problem is that, like, whose E are we talking about? Whose earnings? Well, you have to make forecasts of those earnings, and you also have to take into account what other people are believing about the E. And then the next part of the whole thing is like, which year are we talking about? Sure, and Nvidia is not trading at PE 10 now, but if I look 5 years out, depending on exactly how you make your forecasts, then Nvidia actually is trading at a PE of 10. So I can buy Nvidia at PE 10 or below. It's just a question of whose E and what year. But the principle still holds. That is what I'm doing. I'm not trying to. If I can't find a year and an earnings forecast that allows me for buying that cheaply, then I will not buy that company. I mean, I wouldn't buy Nvidia if it was expensive. So if I can't find a year that I'm satisfied with a P below 10, then that won't happen. I wouldn't buy it just because there's a trend of buying Nvidia, or that it's an excellent company or has a good position or a super manager or anything like that. things don't really get into my judgment until after I've seen that the stock can be cheap at a certain year. I understand that. I hope that this is how every value conscious manager would do it, but I tend to like turn things around and see things from the sorry, from the other side. So that's the other side of it, and that's why it sounds so stupid, naive, simple. Because like, of course, you want to buy Nvidia at below PE 10. The question is just, how do you do it? How do you find the right perspective of establishing that you can do that? And then we come to principle number 2. It's that I call it just the status quo principle. There is nothing new under the sun. There is no real reason to have these visionary ideas of change. Rather, I base my investment ideas, my forecasts, my trend analysis. Everything is typically based on the idea of mean reversion. Things will come back to where they have always been, and things will keep being the way they are and that they have always been. The question then again is, of course, what is it that is? To make it more concrete, if I'm analyzing a fundamental variable like sales, then I want to find the pattern that is stable and reliable enough to actually make forecasts based on that. So I start by looking at sales. And if you're really lucky, you have a company where the sales number is exactly the same every year. They sell for $100 billion every year. That's pretty easy to forecast. Like if they've done that for 20 years, they will probably do it again. There is something inherent in the company that makes their sales completely stable. Another company might increase their sales by exactly 10% every year, and have done that for 20 years. Then, it's a pretty good guess that they will increase their sales by 10% next year as well. Of course, you would want to get into the weeds of the company and understand why this happens, of course, to reduce your uncertainty. So that's either you have the fundamental variable or the derivative of the fundamental variable, and then the next step is, of course, to take the second derivative of the fundamental variable. So in this case, it would be the rate of change of growth, of the growth rate. So maybe the company has increased their sales by 10%, then 9%, then 8%, then 7%. Well, a pretty good guess they will probably increase their sales by just 6% next year and 5% the year after that, given, of course, that you have some kind of slightly deeper reasoning about why that is. But at least you've found a pattern. And then there are these cyclical companies where you will find cyclical patterns, and there are growth companies where you will find these S curves that interlock into each other. So you get one S curve and then followed by another S curve. A typical company would be Apple, that whenever they launch a new product, they get kind of or enter a new country or a new area, they create these S curves. So what I'm saying here is just that the world doesn't change; it keeps being exactly as it is. But you have to find out what that status quo is. So find something that is stable enough. You take derivations of variables until you get something that is flat, something that you actually can rely on. So these are probably my two most important philosophies: buy cheap and don't expect change. Another is that I used to think way back that if I have made a decision, if I have made my calculations, I've made my I've made my research, I think I understand everything about this company and its industry and where it's going, then my job is just to keep buying more shares if the share price is falling. I've given that up because I've realized that you can never know. You can never be that certain that you end up going all in on anything. So you don't have to win every battle. I used to think that I had to, and that once you've started in investing in a company, and then I mean investing time and resources and then also capital, then you had to kind of win that one and win back your money on that one, either going short or long, just using your information. But over time, I actually finally realized the wisdom of stop losses. Like the market is actually telling you something, and sooner or later, just give up and take your stop loss. Try to find some way to rationalize why you should take your stop loss, and like if you keep ranking a lot of different investment alternatives, you will always have something that is better and more appealing than that irritating loss-making position that you keep there and that you think you know everything about, but apparently you keep being wrong every day. That's just a waste of energy. However, saying this, and this is kind of a meta observation of the entire industry, is that there is always wisdom in both opposing sides. This is something that you in philosophy call coincidence of opposites. So a value-conscious investor, what they want to do is buy something that others don't like, that they don't want, that they value too little, and you understand that there is value there and that it will be manifest in the future. But on the other hand, if nobody, if the market is telling you that you're wrong, then maybe you actually are wrong, and there will be something coming up in the future that just changes your perspective. And this goes on from all kinds of perspectives in investing. That there are always two sides. There are always two really informed and invested and engaged sides that come to the absolute opposite conclusions, and that's why there is a market. Somebody's buying, somebody is selling, and they have more or less access to the same information, all of them. So just realizing that a market is a market can actually help in making better investment decisions.
So if I can summarize, one is you buy, two is you know what's the status quo, and of course B, that use like time horizon, stop loss is something that you do. So my last word go to Q&A, because I know my colleagues have a lot of questions for you. So with so many macroeconomic and inflation, AI, the energy, Bitcoin, gold. So when you're investing head on, what's at top of mind?
Absolute top of mind is electrification. Anything that has to do with this mega trend of using less fossil fuels and more electrical motors, using more electrical energy, that creates a huge strain on the economy, a huge strain on all our infrastructure and like both energy generation, electricity generation, maybe I should say, and energy storage, any type of material that the mineral resources the minerals that you need to go into these industries. So I'm looking at mining, nuclear power, solar energy, batteries, but also like coal and coal plants, because even if there is a push to reduce these things, to reduce fossil fuel, it became apparent just the last 2 or 3 years in Europe that when you start producing more and more of your total energy consumption, when you produce it with renewables, then you have less of a base generation that takes care of the base load, and that means that once you get into a panic situation where it's about keeping your population warm and your factories up, then you have to restart your coal plants or natural gas plants. So that's also a part of the whole thing. But electrification and real assets. I don't think that this little bout of inflation after the COVID pandemic, I don't think it's totally over. I think that was there is still a lot of imbalances in the world in terms of debt and deficits on the government level, which means that fiat money and the creation of currency that will keep being a big theme for a long time, probably as long as we can imagine. And that means that anything that's real will rise in value. So gold, silver, uranium, ether, Bitcoin, real estate as well, and also distressed debt. Like if you can buy distressed debt at super cheap values, just like Howard Marks realized when he started out like 50 years ago or so, that can hold like real value. But in any case, things that are inflation protected. So that's electrification, real assets, also anything that has to do with automation. We are in the era of automation. So there will be more robots, more drones, of course, some kind of artificial intelligence that is part of automating services and other tasks that are not that mechanical. It's of course hard to pinpoint exactly which companies you should go for. I mean, how do you find an AI company that isn't overinvested, that isn't like super expensive due to this whole passive investing and in indexation disease we see throughout the market, where the Magnificent Seven become, well, in theory, overvalued because there is the money automatically goes into just those companies. And maybe fourth, I'm thinking about whether we're actually going into a new world order like we typically do about once a century. Is there a fourth turning actually going to happen now with political turmoil, geopolitical turmoil, possibly even like kinetic wars, but at least pretty likely digital wars, maybe. And what might a big change like this, what might it lead to? Like, could there be a war where China takes over Taiwan, for example? Would Russia do something really desperate? And what will happen to multinational supply chains? Are we going into more of a home shoring era? And I think if there is a kind of fourth turning with a lot of turmoil, then that would only make the previous trends even stronger, the electrification, real assets and automation trends, because that would mean that you cannot any longer rely on cheap labor overseas or just-in-time deliveries. You would have to automate more, and there will keep being a pressure to make this automation based on renewable energy. Electrification, real assets, and automation, and possibly, well, I should add like a kind of a tip to anybody who is ambitious and trying to like create a spot for themselves is to become native on whatever technology platform arises. Like right now, if I were a teenager or in my early 20s, I would try to become a native on Apple Vision Pro or some other VR platforms. I will also make sure I use AI tools every day, like image generation, video generation, perhaps not coding, but at least some kind of systems control. Just try to spend hours, which like young people typically want to do anyway, on playing games. But not stupid games, but collaborative games and games that include like playing with all these new tools, to just make sure that you actually understand what does the VR tools promise and what doesn't actually work. What is just like media hype, and from there you might like stumble upon what what will be the new super companies that inevitably will rise to the top of the S&P 500. So
if I can summarize, so basically you themes all of our findings. One is education and real asset, mentioned Bitcoin, right? And then number 3 is forwarding. 4 is pay attention to any rise trend, trying to stop basically emerging concept big. So all I have, I think we'll get some questions from first, then we'll go online. If there's any questions from audience, of course, yes, Steve. What was your trade?
My worst trading. I love it that it's a very, very short and concise question. My absolute worst trade was in 2013, the early spring and summer of 2013. I was short European banks. I had been short European banks back in 2012 as well, and managed to catch the ride down pretty well based on increasing financial troubles for the so-called PIGS countries: Portugal, Ireland, Italy, Greece, and Spain. I saw early in 2013 how there was going to be a replay on that, because the assets that the banks were holding on their balance sheets were just really, really crap, and they didn't mark them to market, which meant that there were huge latent losses. That meant that a lot of the really the largest banks in Europe were actually bankrupt if they were to mark to market, and they were bound to have to sooner or later raise capital at very low share prices, which would mean dilution, and would mean that the banking sector would crash even further down, and probably also pull down the general economy, because their capacity to lend out money would shrink. So I thought that this was more or less inevitable. So I was short the banking sector in early 2013 and through the summer, and actually that position in the beginning, the first few months, saved the entire fund's result, because we were losing money on other stuff that weren't my responsibility. However, going out of the summer of 2013, the European Central Bank they kept changing the rules, and they kept supporting the banks, and in a way that I didn't understand and couldn't really imagine. So I kept holding on to my short position of European large cap banks like Deutsche Bank and Société Générale, Banco Bilbao, etc. Throughout the fall, so the autumn, and by the end of the process, starting with the turning points in the summer, where from the turning point where my position looked really, really good, until I finally caved and took the stop loss, grudgingly so, because I still hadn't really realized my error, or that the central bank could actually keep this going indefinitely. By then, I had lost $100 million on my position, and that was about 10% of the entire hedge fund. So more or less on one position, losing 10 percentage points of our returns. I actually can't remember if 2013 was one of our losing years or not, but in any case, I was responsible for our not having a pretty good year, and that was, truly devastating. Like if we were 3 senior partners, 3 portfolio managers, my responsibility was having about 350 million, and I lost 100 million in less than half a year on a single trade. That's pretty bad.
Got it. Thanks, Mike. For David or not? Go ahead.
Yeah, can you hear me?
Sure.
Yes, really. Thank you very much for your time. I just was a bit confused in terms of, you mentioned that you are looking for loopy, stable typical stocks, which are vertical features of values, right? But then you mentioned that the industries you are most interested in are more like growth industries that are emerging, pretty much high uncertainties in terms of forecasts and companies' results. So I was just wondering how those two things sort of align, or like, is there some sort of discrepancy there really in terms of what you actually like and what you need to look into?
Yeah, well, there is always a coincidence of opposites when it comes to me. So on the one hand, if I'm answering as a professional fund manager, then I gravitate toward maybe the top 50 or maybe top 100 companies in S&P, and that means stable, predictable, even if they're cyclical companies. So that would not really include silver mines or uranium mines or gold mines, or new fast-growing semiconductor companies, or newcomers, upcomers. But in my private investments, then I even if I still think in terms of the status quo and predictability, and actually in a way not trying to make predictions. That is, by the way, one of my most important lessons that I have learned throughout my time in the industry is to make as little predictions as possible and just go with the information that you actually already have. But sure, there is definitely a paradox here where I am constantly enticed and do invest in startups. I have a portfolio of about a dozen startups right now, for example, that are private companies, and I've had about a dozen total defaults, total losses, bankruptcies due to my investment style in my private portfolio. And at the same time, I think that more rationally, logically, I should stay away from that because it's so much hassle. And in the end, it's definitely debatable whether it gives me a higher return or not. Sure, I have had 3 100 baggers, but they have not been the ones where I put the most money to use. So they more or less just barely outweigh in terms of performance whatever I lost on my dozen bankruptcies. In totality of it all, sure, it has been an interesting experience, interesting ride. But from an investment perspective and in terms of peace of mind and returns, so let's call it a risk-adjusted, peace of mind-adjusted return, then that investment style has not been productive. And yet I can't stop doing it. So it's probably just that I personally crave some kind of action. But when I'm working as an actual professional fund manager, I keep all of that in check because I always know that there is a client on the other side, and I have a fiduciary duty, and I've also said what my investing style is, and then I stick to that. So yeah, you spotted like a huge discrepancy in my different styles, and but that's just that's the way it is.
That's very interesting, thank you. And another one, if I may. This was very interesting. You mentioned about investing startups, and I just recently read an article about emerging industries, like how did you guys face things. And I was just wondering if you are a buyer, but actually get long-term trends. I understand that you're quite open market of 500, but do you actually keep half an eye out for emerging technology startups that are still private but might actually become public at some point, or that's the radar as an investor? Maybe you look at it when they make it there.
I used to keep track of that in a much more systematic way when I was a sell-side analyst, so back in the 90s. And then we used to go to these like tech fairs there was this huge one in Stuttgart or was it Frankfurt in Germany, and and these days, for a while I did keep track of. There are these websites where you can see all the investments in interesting investments in new startups, just to see whatever trends are emerging. But honestly, these days I do not keep track of that at all. So I just I do read a couple of tech newsletters that that do track these things, and but it's not really systematical. And I'm not looking to invest in the next wave. I'm not trying to find whatever will be successful in 10 years' time. I'd like to see this whole startup investing thing as almost as a disease that you have to try to get away from. In a way, actively stay away from finding those trends, because I know that they will entice me, and I will start getting this selective perception of these companies, and thinking that I can invest in this graphene company, or in this biotech company, or this nanotech company. I mean, I've been looking for nanotech companies since I first read Eric Drexler's The Coming Era of Nanotechnology, and Engines of Creation. But there is no nanotechnology coming that I will invest in any way. So I'm actually trying to stay away from looking at those trends. And when it comes to, just because to answer the latent question here, the startups that I do invest in, they are simply investments that happen to come my way. My instinct and my aim is to say no to every new investment idea. But after saying no 20 times, and the number 21 comes along and it's just so good, then I fall prey for that. So I do invest, and sometimes it works out, and sometimes it doesn't. But no, I think it's to keep track of those companies. That should be more of a pastime and something that you think is just for the fun of it, rather than as an investor. And it's much more productive to catch companies that already have a position, that already are pretty established. I mean, you could have bought Facebook 2 years ago at just $100, and which I did, by the way, because there was nothing saying that they were losing their position in any way. They had 3 billion eyeballs, or 3 billion users, and the only thing that happened really was that Mark Zuckerberg said that we're going to invest pretty lot of money into VR, but there was no reason to believe that he would just squander Facebook's opportunities and position. So I think that finding companies like that, and situations like that, and waiting for like fat pitches in huge downturns, that is much more productive. It's much more productive trying to buy Nvidia or Facebook or Spotify or what have you, when they are just temporarily down on perception, general perception, rather than trying to find these like super cool new companies and make a 1,000-fold return.
Alright, so I realize we are almost maybe one last question. Last minute question. The room from online. Ready? Last question, last chance. Okay. If not, so Mike, first of us want to know more about you. Where do you find your work, your podcast, side courses? Can you tell more?
Yeah, the absolute easiest way to find your way to me is through my website, michaelsyding.com. You'll get the spelling from Andrianto. There are links to all my relevant spaces. For example, Substack, which is my main communication channel, but my website will still always be like the portal to everything else. But it's my Substack where I share my most interesting material these days. And also, as you said, I do have this online investing course, which is called The Investing Course, and it's located on theinvestingcourse.com. So if you or anybody you know would be interested in like my complete view on how to make valuations, forecasts, and investing in stocks and managing stock portfolios, then theinvestingcourse.com is where it's at. And well, if you're not interested, if you hear somebody that is interested, so just feel free to tell your friends about the investing course and ask for a Bernstein discount, and I'll take care of that.
Nice. All right. So thank you so much, Mike. We appreciate your time, wise wisdom, and keep in touch with you.
Of course. Thank you. Cheers.
All right, bye.